So let's go to Southern Africa, where the Reserve Bank is planning to transit from the current Johannesburg interbank rate average, what we call the JIBA, to South Africa Rand Overnight Index Average, effective the 1st of December 2026. Now, speaking at the Monetary Policy Group Forum on Wednesday, the Reserve Bank's Deputy Governor, Rashad Kazim, called for a more agile and coordinated monetary policy responses as global uncertainties persist, while rapid technological change will require central banks to strengthen their forecasting and adapt their policy tools. Let's take a listen.
It's very interesting for me, having spent several years as a Monetary Policy Committee member in the Sarb, and when I thought about the policy rate, I thought about, the repo rate, and then I thought about all the floating rates in the economy. So, we cut repo rate by 50 basis points, your mortgage rates go down by 50 basis points, your borrowing on working capital. And in my kind of simplified mind, as a statistician joining the Sarb, that's what I thought is the transmission mechanism. Little did I realize that there are many rates, market rates in the economy, other than the policy rate, that is the major driver, for the monetary policy transmission process. It's a major driver for the way the economy works, and that we set the policy rate, but there are many other market rates that matter, and to the extent that those market rates reflect true market rates, our actions, the way we organize the market is obviously a critical part. And it took me a really long time as a kind of pedestrian macroeconomist to really understand what benchmark rates mean in the economy. So it's been an interesting journey for me and my own education as the Deputy Governor. But I guess I should stick to my script. As you may recall, the Market Practitioners Group was established, primarily, and this is a bit of history for many of you who have been coming to this, to develop new reference rate for South Africa. It's often said that creating these new reference rates in the financial market is like, building a house, lots of tensions in the house, strain on the family, but in the end there hasn't been a divorce and things are working well, and I guess that's how we feel about this. It has been 8 years to reach this point, starting with the Sarb consultation paper on alternative interest rate benchmarks. Now, I've been, as someone who's been chairing for the last maybe 3 years or so, I've been chairing the Market Practitioners Group. I was, really overwhelmed with the expertise in the country, with the banks, with the non-banks in the financial sector, and how this, it's often said as a cliche, public-private partnership, but this is really a clear manifestation, an exemplary case of how the public sector, the Sarb, and those of you in the private sector should work. So it was 4 years ago, sounds just like yesterday maybe, that the MPG and the South African Reserve Bank agreed to phase out JIBA by the end of 2026. Lots of literature on why we need to do that, why we phase out LIBOR and many of the others. About 7 months ago, we launched the Zeronia First initiative. Since then, we have noted a significant increase in the adoption of Zeronia from 6.4 billion to over 200 billion in the initial months. Of course, JIBA exposures remain high. As of mid-2025, domestic JIBA exposures were estimated at 43 trillion, while offshore exposures were about 107 trillion. I hope I got my numbers right. Early this year, the MPG officially adopted methods for determining credit adjustment spreads and recommended JIBA fallback rates based on compounded Zeronia rates. As we approach the JIBA secession date, there are three issues of concern to the Sarb and the NGP and MPG. So many MPs that I'm busy sitting in that I forget. So the first is there are all these funny terms we have. that the MPG has created. The first is what we call the No New JIBAR event. We are already encouraging market participants to use Zeronia instead of JIBAR in contracts, but around the second quarter of next year, we plan, along with the Financial Conduct Authority, FSCA, to issue regulations limiting new JIBAR exposures.